Good evening. This is Greg Mooney. I'm the Senior VP of Marketing for Treasurer's Briefcase. Dave, are you on? Do you have audio?
I am here.
Great. Well, I'm happy to kick off the Treasurer's Briefcase Fall Webinar Series. And this is made up of 9 webinars that are scheduled between tonight and our last one for the fall being on December 9th. And our goal is to provide current and prospective users with a simple and straightforward review of key topics that nonprofit treasurers need to know. More webinars are scheduled for 2016 with subjects that will help everyone keep up with the changes in nonprofits, as well as changes to Treasurer's Briefcase. So let me introduce Dave Lau, our speaker for tonight. Dave is a principal with Treasurer's Briefcase and a CPA with 31 years of tax and accounting experience. Dave knows your pain, as he's been a volunteer for multiple organizations over the last 25 years, and in doing so, recognized a large gap in the support and resources available for those who want to lend their time to local, small, typically all volunteer organizations, and hence the creation of Treasurer's Briefcase. So Dave, why don't you take it away and walk us through?
Thanks, Greg. Today's webinar is more or less a theoretical dive into record keeping for small nonprofit organizations. Our goal by the end of today's presentation will be for you to understand the unique difference between traditional accounting and nonprofit record keeping, to learn the 3 functions, or what we call buckets, under which the IRS requires you to report your activity, to see why the IRS and other interested third parties want you to report in this unique manner, to get a firm grasp of the differences between the 3 buckets, and work with some examples, to become informed about the public inspection rules, which is a pretty important rule that you need to know. We're going to teach you a little bit about developing a record retention policy for your organization. And then we're going to take 3 minutes to show you a little bit about Treasurer's Briefcase and how simple, fast, and easy it will make your task. Let's first start, most importantly, by defining the basic principle or goal of accounting or record keeping, which is to paint a picture for an audience. In this case, it's the picture of financial history. The first step in understanding accounting for nonprofits is really understanding the difference between for-profit and not-for-profit financial statements. The for-profit goal is to see how your revenues were, how well you managed your expenses, did you turn a profit for the owners and shareholders. So on the screen currently is a typical example of a for-profit entity in which you look at a financial and it reports revenues, the costs of the sales, and then all the related selling, general, administrative expenses that occur to give you what's called your net profit before taxes. The big distinction with nonprofit organizations is they really aren't trying to make a profit. They're just trying to support their organization. And in a perfect world, if budgeting could be perfect, at the end of each year, they'd wind up with a 0 balance in their checking account and they'd start all over again. Notice the difference in the descriptions now. A typical nonprofit financial statement reports revenues broken up into what we call those 3 buckets: contribution, gifts, and grants, fundraising revenues, program service revenues. And then we show the expenses broken down in the same manner: program service expenses, fundraising expenses, and then your management and general expenses to come up with what's called the change in net assets. Notice we don't call it net profit. It's just the change in net assets for the year. Basically, the picture you're painting for a nonprofit through a nonprofit financial is how well did we support our cause. To help readers of tax returns and financials determine whether an organization is in fact fulfilling their mission, nonprofits report activity by function or buckets, as I mentioned. The buckets are broken down between programs, fundraising, and administrative costs. In effect, your tax return or financial statement becomes your report card. Keep in mind that when you completed your request for tax exempt status with the IRS or agreed to be a member of a group and follow their group exemption, you told the IRS who you are, who you were going to support, and how you were going to do it. And based on that, they gave you approval to be a nonprofit organization. So requiring charitable organizations to report expenses under the three-bucket method enables the IRS and donors to determine if an appropriate amount of expenditures is being directed to the activity of your organization. I'll give you a quick real-life example of an abuse of that issue. We had a client, it was a social club, which is tax exempt. It's just not a charitable organization. And that social club, I found out, was actually selling raffle tickets, if you will, or pick three numbers to the general public. And they were taking the money and going on hunting trips for themselves. That's clearly a violation of IRS rules. You can't take the general public money and spend it on yourself. The IRS, once they look at that tax return, would recognize that and in all likelihood cause them to be a taxable entity and have to owe some tax. At this point, I want to describe in detail those three buckets we talked about. So the first one I'm going to talk about is the fundraising and contribution, gifts, and grants bucket. Many groups call it the ways and means. It includes fundraising events as well as the sale of goods for fundraising purposes. Fundraising costs associated with all those fundraisers would be posted to this category, and they can also include the cost of soliciting others to contribute money or property or time, or even the use of facilities, or the costs, for example, to encourage contributions. For instance, if I went to a workshop to learn how to improve my fundraising techniques, the cost of that workshop really is a fundraising expense and falls into the fundraising bucket. The next category is programs expense. They are the direct and indirect cash receipts and disbursements to provide the organization's programs and social services. In effect, it's the reason you exist. It's the reason the IRS gave you a tax-exempt status. Most often, you'll find that you'll be recording cash disbursements related to the fundraising category. To the program category, pardon me. But there will be occasions where you'll actually receive receipts in the program category, and we'll talk about that a little bit later in the webinar. And then finally, the last thing you'll run into are typical general administrative expenses. They're the management and general expenses that aren't easily identifiable to a bucket or fundraising activity or a program, but they're crucial to the organization's continued existence. For instance, just simple office supplies or telephone expense. So if you properly categorize everything and file a tax return properly, your organization, the reader of your organization's return will get a pretty good picture of who you are and how you spent your money. I developed a list of 10 things a typical reader of the 990 would be able to learn just from looking at your 990. They'd be able to figure out your identity and your tax status, whether you're a 501c3, 501c5, 501c7, how much income you received and from what sources, your expense breakdown among fundraising, program, or management expenses, what your net assets were at the end of the year. They'll actually look at descriptions, narratives of the kind of programs and see how much you spent on them during the year. They'll be able to see who the board members are and, in fact, how much they were paid. They'll notice if you changed any of your activities, in other words, changed your purpose, or entered into any excess benefit transactions. We'll describe them in a future seminar. They'll see if you engage in any self-dealing transactions, another topic, bigger topic for a later seminar. If you're a private foundation as compared to a public charity, or if you actually lobby for your organization. Another reason to keep good records and understand how to properly file a tax return is something a lot of people are not aware of, which is that your tax returns are open to the public. And in fact, the IRS, this comes right from the IRS website, this wording. The IRS requires you that if somebody shows up to your doorstep for a copy of your tax return, you must immediately provide them with a copy. If they give you a written request, you have 30 days to get them a copy of the tax return. So again, you don't want to give them a tax return that isn't prepared properly or doesn't categorize your activity properly because it may be viewed negatively against your organization. I'm going to show you a typical example of a very, very complicated 990. This was a public document I received right off of a website, GuideStar. And this is literally baseball's 990. It's again, it's the most complicated form of tax return you could file. But the point is that I want to show you how your buckets, as we define them, tie into this tax return. So I'm going to go down a little bit on this tax return. Again, this is a very long tax return, but there's a ton of information you can get. You'll see in here, this is where the officers' compensation would be. In fact, there were so many officers, they had to attach an addendum with the information. A good example of other information you get, their largest vendors, Little League Baseball's largest vendors and how much was paid to them. But here is the section I highlighted for you. I just want to show you, this is a statement of revenues, and you can see how our concept of buckets plays out on this statement of revenues. All the contribution and gifts and grants have to be reported in one section. That's the fundraising bucket. The revenue from program services is another program bucket, as we noted. And then finally, all the fundraising income is the third bucket that we noted. So you can see the tax return itself forces you to break down that income based on which bucket it should go to, which function it should go to, fundraising, program, or contribution, gifts, and grants. In this case, again, a reader of this tax return could easily see, oh, geez, the TV actually pays for the World Series rights $4.2 million. That's a little interesting tidbit for conversation, but you can get all that information. If I went further down, they break down the expenses for the organization. Again, forcing you to break them down based on the buckets. You have to break down all your various expenses based on program service, whether they're program service related expenses, whether they're management and general expenses, or whether they're fundraising expenses. When it's all said and done, a reader of these financials would be able to look at this information. For example, out of $27 million of operating budget from an expense standpoint, only $3 million was spent on management in general. I would say that's a pretty good percentage. So less than 10% or a little bit more than 10% is management in general, and $24 million is spent specifically on their program. So they're a nice, healthy organization supporting their cause. So at this point, just to kind of drive home this concept of the buckets, the fundraising, administrative, and program bucket, I'm going to list a couple of examples and we'll decide which bucket they belong to. In this case, postage for sending out this month's bills, that's a typical administrative expense. It wouldn't be allocated to a fundraiser or to a program. It's a necessary evil of operating our organization. So it will be posted under the administrative category to an account called postage. In this example, the PTA pays for a new overhead projector for the 4th grade class. This would be a program category expense. A PTA exists. The sole reason a PTA exists is to support the classroom and the teachers. So this expense would be a program category expense. We would recommend putting it to a category called classroom enrichment. Travel soccer team treasurer pays for the candy the players will be selling. The cost of the candy is a fundraising function. And then later, the treasurer deposits money received from selling the candy. The deposit of those funds is also a fundraising category. Some more examples. The PTA treasurer pays for the postage for sending out the solicitation campaign. This would be a form of fundraising costs or expenses. And here's a little more complicated one. The PTA does a mass mailing to all parents, including a brochure related to underage drinking and a donation solicitation. This expense really should be allocated between program expense and fundraising expense, as the category, as the mailing serves two purposes: fundraising as well as educational awareness for the students. Finally, to just give you an idea how complicated it could be and how much detail the IRS would love to receive from you, I'm going to give you a final example. In this example, for the silent auction, Donald Trump donates a week stay at one of the colleges at Trump National Golf Club. The retail value of that donation is $4,000. At the silent auction, Hillary Clinton bids on the cottage and wins the bid with a price of $6,500. The question is, how do you record this mess so the IRS is happy? Well, the reality is we have a couple things going on. First of all, Donald Trump made a contribution. It happened to be a contribution, a non-cash contribution, but it was still a contribution. So from a record-keeping standpoint, that contribution would have to be recorded. We also had a fundraising revenue. We raised $4,000 from Hillary Clinton, even though she paid $6,500. $4,000 of that was the fair value of the product she bought, or in this case, the timeshare, the time in the unit. There's also a cost to that. The cost is the cost of 1 week stay at Trump's facility. And then finally, that extra $2,500 that Hillary donated would come through back as a contribution. In a future seminar, we'll show you exactly how to record all this, but you can see how you have to think through each transaction to make sure it's reported properly for the IRS. As Greg said earlier, I can feel your pain because I was once multiple times a treasurer for 3 different organizations. So one of the rule of thumbs I came up with that I think works really well is to ask yourself, is this receipt or expense related to the reason we exist? If the answer is no, but it generates some form of cash receipt, in all likelihood, it's a fundraising item. Otherwise, it's probably a general administrative expenses. And let me give you another example, real life example from my history. I was the treasurer for Babe Ruth Baseball League. We host a World Series in our community. It's a major event, and one of the things we do is charge for parking. So the question is, does the money come from charging people to park in our parking lot a fundraising income or a program income? Now, I would argue, and I did file this way, that it's program income. We exist to put on baseball events to promote the game of baseball to the community and to the world. So that was all part of that major event, the World Series, and therefore those revenues fall into the program category. We also rent our parking lot out to a local organization who uses it for a flea market. We don't exist to put on flea markets. We exist to promote baseball. Therefore, the money that came in from renting the parking lot to the flea market would be fundraising revenue. I want to talk briefly about record retention. Treasurer's Briefcase on our website. We have a great tool for you to review on record retention. It's under the resource section, under the category called Your Briefcase. I'm going to step back and tell you the whole reason I came up with the idea for Treasurer's Briefcase was because when I was appointed treasurer of a Little League baseball group, a Little League team organization that's been around since the early 50s, I literally was handed about 8 bankers boxes from the previous treasurer. And it was my job to sort through that, try to figure out what was important, what wasn't important. Unfortunately, a lot of the stuff he kept wasn't even important. And the most important things he didn't keep. Treasurer's Briefcase has a digital briefcase component to the software where you can store all of your documents digitally and they'll be there forever. So when you transfer from treasurer to treasurer, all you do is give them a new login credential and they'll see all of your documents in one place in your digital briefcase. But for reference purposes, you need to know what you should be keeping and what you don't need to keep. We have a list on the Treasurer's Briefcase website, again, under the resource section, under Your Briefcase. And it lists out all the permanent documents you should keep. Clearly, you're going to keep your articles of incorporation, your bylaws, most importantly, your determination letter from the IRS that proves you're a legal tax-exempt organization, federal ID number information, and all the important documents that you would want to keep for a lifetime. We also have a section down here where we detail how long we suggest keeping various records, from anywhere from 4 years to 7 years to 10 years. It's a great tool. I suggest you review it. It'll help you stay on point with your record keeping. So now that you have all this information, what do you do with it? What do you do with all this new knowledge you've obtained? You learned the 3 buckets the IRS wants you to focus on. You've learned what typically goes in those buckets. You understand you have to be ready to provide your tax returns at any moment. And finally, we've suggested some record keeping rules. So really, whether you're using Excel, whether you're using Intuit, Peachtree, or manually keeping your books, you need to always keep the 3 buckets in mind: programs, fundraising, and administrative. So you need to design your system to accommodate that information so you can do a financial statement if needed and a tax return, most importantly, in the correct manner for the IRS. Treasurer's Briefcase, the whole reason it was created was to take the pain out of this process. We've created it in a way that makes the process very, very simple, fast, and easy. So at this point, I'm just going to give you a quick demo of purely the category section of our software and how that translates into financial statements. So this is the main menu of our software. Some of you have been using it and are pretty comfortable with it. But under this settings tab, we have a category section. And you're going to notice the category section looks strikingly familiar to the buckets we defined: fundraising, administrative, programs, contribution, gifts, and grants. There's one extra one here. The IRS does require you to separate investment income from other income, so we have it here also. You'll notice whenever you click, you can get a drop down and expand your drop down into all the various categories. This is not static information. You can add to this as much as you want. If you start a new fundraiser next year and it's not in our pre-populated list, which we provide you, you can always add a new category. You can also hide categories if you don't ever use them. But most importantly, you'll see they're all broken down into the buckets. Assuming when you enter transactions into your checking account, you post them or record them to the proper buckets and proper categories, preparing a treasurer's report is actually very, very simple. You would go to your reports menu. In this case, I'm going to go to custom reports. I'm going to click for the current fiscal year, my treasurer's report, and I'm going to generate it. You'll notice I can generate it as a PDF or as an Excel. I can view it. I can file it in my treasurer's briefcase, my digital briefcase, or I can email it. I'll view it. And you'll see just like that, we've created our treasurer's report. So in this case, you'll see we've broken down our income into the various components: contributions, fundraising, investment, and programs. And then the expenses are broken down the same way: administrative, fundraising, programs, to show you the net result for the period, and therefore the what the true ending balance is, or the net assets that we have. And at this point, I think we're going to take some questions, see if there's any questions out there. And if anybody has any questions, feel free to jump in. I do see one question that comes in, and the question is, it's a really good question, actually. Our revenues will always be less than $50,000, so we only have to file the 990N postcard. Therefore, none of this information is required. So why do I need to keep our records this way? For a couple of reasons. One, in our state, the state of New Jersey, if our receipts are more than $10,000, we have to file a charities registration form each year. There's a long form and a short form, but in both cases, we have to break down all of our income and expenses based on the IRS format that we've talked to you about, the 3 buckets. There's another reason, and this is a real life situation that's happened to an organization I was involved in, and that is they were filing for a period that they hadn't filed returns at all. We got them cleaned up, but they were only filing 990N. The previous treasurers really didn't do a good job with the reports. And suddenly one of the biggest corporations in our community, a big pharmaceutical, let us know that there was funding available if we could just give them information that proved we were supporting our cause properly and proved that we were filing tax returns on time. Unfortunately, we couldn't give them enough information quickly enough because the previous treasurers hadn't done their job. So there are more reasons than just the IRS to do this kind of work. And I do not see any more questions. No more questions.
Well, great job, Dave. This is Greg Mooney speaking again. That was very informative, and I took away a few new tidbits too to utilize with my nonprofit that I work with. So I want to thank everybody for attending this evening. I know you're all busy, not the least of which with managing the affairs of the nonprofit. If you are already subscribed to Treasurer's Briefcase, thank you very much. And hopefully you took something away today and learned how to use the Treasurer's Briefcase tool or make it more valuable to you. And if you haven't already subscribed, please subscribe. It's very easy to use, and I think you'll find the value to be very just a great value. Let me put it that way. So we've got our next webinar scheduled for Wednesday, October 14th, and that is titled Treasurer's Briefcase, a Quick Tour. So again, I want to thank everybody. Appreciate your time. And Dave, if you want to jump in and
Yep. Thank you, folks. Yep. Great. Thank you. And if you ever have questions for us on the main page of Treasurer's Briefcase, there is a contact us section. So feel free to reach out and contact us, and we'll get back to you quickly. Thanks for your time.